The United States dollar has lost 97% of its purchasing power since 1913. This represents 97%. That means a loaf of bread that cost 5 cents back then would cost you $4 today. But here is what nobody is telling you. That was not an accident. It was not the natural evolution of markets. It was economic warfare. The playbook being used against your savings right now was literally written by the KGB in the 1970s. I am talking about a 6-stage manual. This is an actual strategic document designed to collapse the dollar without firing a single shot. Here's the disturbing part. We are currently at stage 5. Your retirement account, your savings, and the cash sitting in your checking account are all caught in a systematic destruction pattern. This pattern has been deployed against currencies 17 times in the last century. Every single time, the middle class got annihilated. This happened every time. This is not coming in 20 years. The mechanisms are already in motion right now, today. By the end of this video, I am going to show you exactly which stage we are in. I will also explain how the next stage unfolds. Finally, I will tell you what you can do about it before your purchasing power evaporates. Because here's the thing. When this pattern completes, when we hit stage 6, 90% of Americans will see their wealth cut in half. This will occur in less than 18 months, not over a generation. This will happen in 18 months. Let me start with something most people do not understand. Currency destruction follows a pattern. It always has, and it always will. There is a 6-stage pattern that has destroyed the German mark, the Argentine peso, the Zimbabwean dollar, and the Venezuelan bolivar. It has also destroyed 13 other major currencies in the last 100 years. This is not theory. This is pattern recognition. Consider Weimar Germany in 1923. A wheelbarrow full of marks could not buy a loaf of bread. In Argentina, during 2001, the peso collapsed from parity with the dollar to 4-to-1 overnight. Life savings vanished. In Venezuela, during 2017, inflation hit 1,000,000%. People were hunting dogs in the streets for food. The pattern was identical every single time. It involved 6 stages. These were 6 predictable, mechanical steps from stability to collapse. This is not prophecy. It is historical record. It is mathematics. This is the inevitable outcome when specific conditions align and specific policies get implemented. But here is what makes the current situation different. This is not happening by accident. This is not incompetence or bad policy. This is strategic economic warfare using a playbook that was literally documented and archived. Let me take you back to 1974. That is when everything you are seeing right now was planned. It was 1974. The location was Moscow. The Soviet Union was locked in an existential struggle with the United States. They knew they could not win a direct military confrontation. The American industrial base was too strong. The nuclear arsenal was too vast. So they developed something else. This was something quieter. It would take decades to execute, but would be absolutely devastating if it worked. Economic warfare. The KGB, under the direction of Yuri Andropov, assembled a team of economists, intelligence operatives, and strategic planners. Their mission was simple. They aimed to figure out how to destroy the dollar without firing a single shot. The result was a classified document. This document would not be discovered in Western archives until 1998. It was buried in the Mitrokhin files. The manual is called Operation Monetary Disruption. It contains 263 pages. It describes 6 stages. Each stage was designed to erode confidence in the dollar systematically until the entire system collapses. Here is how it worked. The foundational principle was elegance itself. You cannot attack the dollar directly. It is too strong. It is too widely held. Furthermore, it is too central to global trade. Instead, you attack the systems that give the dollar its value. These include confidence, scarcity, predictability, and trust in institutions. Stage 1 involved infiltration. This was not military infiltration, but economic infiltration. The goal was to position Soviet sympathetic economists, academics, and policy advisors in Western institutions. These included universities, think tanks, and government advisory positions. They were not spies in the traditional sense. Instead, they were influencers. These were people who would, over time, advocate for policies that seemed reasonable on the surface. However, these policies would systematically weaken the dollar's structural integrity. Let me give you a specific example. In 1976, an economist named Pavel Pavlov defected from the Soviet Union. He brought with him documentation of what he referred to as the Academic Influence Program. The KGB had identified 217 Western economists. They offered them speaking fees, publication opportunities, and research grants. The money came through front organizations like cultural exchanges and academic foundations. The goal was not to recruit them as agents. It was simpler than that. The aim was to normalize certain ideas. These included notions that deficit spending is not dangerous, and money printing can solve economic problems. They also promoted the idea that gold standards are archaic. Furthermore, central banking should be independent from political oversight. Think about that. These were not radical ideas. They sounded reasonable, sophisticated, and modern. And that was the point. You do not destroy a currency by advocating for obviously destructive policies. You destroy it by making destructive policies sound like progress. By 1981, 12 of the 23 economists on the Federal Reserve's advisory board had received funding. This funding came from organizations later identified as KGB fronts. This amounted to 12 of the 23 members. But here is the key. This was just stage 1. It was the setup, the intellectual groundwork. The real damage came in the later stages. Stage 2 was debt expansion. The strategy here was brilliantly simple. It was to encourage the target nation to take on massive amounts of debt. This would not happen overnight, but gradually. Make it seem necessary through economic stimulus, infrastructure investment, social programs, and military spending. Each one was justifiable on its own, but collectively, they created a debt spiral that became mathematically impossible to escape. In 1980, the United States national debt was $900 billion. By 1990, it was $3 trillion. By 2000, it reached $5.7 trillion. The growth was exponential. Now here is what nobody tells you. The Soviet Union was actively encouraging this through multiple channels. First, through the academic influencers from stage 1. Papers were published arguing that debt to gross domestic product ratios did not matter as much as previously thought. They also claimed that the United States could sustain much higher debt levels because of its reserve currency status. Furthermore, they argued that deficit spending during peacetime was not only acceptable, but economically optimal. Second, through political pressure. The Soviet Union maintained a massive military presence in Eastern Europe. This forced the United States to maintain its own military spending at elevated levels. The Reagan administration alone added $1.7 trillion to the national debt, much of it defense-related. This is where it gets disturbing. Leaked documents from the Soviet Ministry of Economic Affairs in 1983 show they were literally modeling American debt accumulation. They had calculated that once the debt exceeded 70% of gross domestic product, the United States would face a choice. This choice was either to dramatically cut spending, which would cause a recession and undermine political stability, or to continue spending, which would require money printing and currency debasement. Either outcome would weaken America. Both outcomes advanced the strategy. By 1985, United States debt hit 72% of gross domestic product. The trap was set. Stage 3 was monetary expansion. This is where the real destruction begins. Once debt reaches critical levels, governments face that choice I mentioned. They must either cut spending or print money. And throughout history, governments always choose to print. The mechanism works like this. The government needs to fund its operations. It issues bonds. But if there are not enough buyers for those bonds, the central bank steps in and creates new money to buy them. This is called monetizing the debt. It is a technical term for something very simple. That is creating money out of thin air. In 1985, the Federal Reserve's balance sheet was $200 billion. By 1995, it was $400 billion. The expansion had begun. But the Soviets understood something critical. You cannot just print money recklessly. That causes immediate inflation and panic. You have to do it gradually. You have to provide cover, such as economic emergencies, financial crises, and recessions. Each one provides justification for monetary expansion. Let me show you the pattern. In 1987, a stock market crash occurred. The Federal Reserve responded by lowering interest rates. It also expanded the money supply. This was justified as a crisis response. In 1990, a savings and loan crisis took place. This led to more monetary expansion and liquidity injection. In 1998, the long-term capital management firm collapsed. This resulted in more intervention and money creation. The dot-com bubble burst in 2000. This prompted more expansion. Each crisis provided cover for the next stage of monetary expansion. Each intervention normalized the idea that the Federal Reserve should respond to every economic problem by creating more money. And here is the thing. The KGB manual explicitly predicted this. Page 147 states that the capitalist system contains the seeds of its own monetary destruction. It also explains that financial instability is inherent to the system. The manual describes their role as not creating crises. Instead, they were to ensure each crisis resulted in monetary expansion. This expansion must exceed the previous expansion. Over time, this creates an irreversible trajectory. Consider the phrase irreversible trajectory. Think about those words. By 2008, the Federal Reserve's balance sheet had expanded to $900 billion. And then came the financial crisis. This is critical. The 2008 financial crisis was not part of the Soviet plan. The Soviet Union had collapsed in 1991. But the mechanisms they had put in motion continued. The intellectual framework was in place. The policy prescriptions were normalized. The debt levels made monetary expansion inevitable. The Federal Reserve's response to 2008 was exactly what the KGB manual had predicted. This would happen in the event of a major financial crisis. The response included quantitative easing. $4.5 trillion were created in 6 years. The balance sheet went from $900 billion to $4.5 trillion. $4.5 trillion were created out of nothing. Stage 4 was asset inflation. This is where the wealth transfer begins. When you create trillions of dollars, that money does not distribute evenly through the economy. It flows to assets first, such as stocks, real estate, and bonds. These are the things that wealthy people own. From 2009 to 2019, the stock market tripled. Real estate in major cities doubled or tripled. However, what about wages? Wages grew by 22% over the same period. Let me break down what this means. If you owned assets, your wealth tripled. If you relied on wages, your income grew by less than a quarter. This is the largest wealth transfer in human history, and it happened through monetary policy. The KGB manual describes this exact phenomenon on page 189. It states that asset inflation creates the appearance of prosperity. However, it actually concentrates wealth and reduces the purchasing power of wages. This process builds social tension. Simultaneously, it enriches the financial class. This class becomes invested in continuing the inflationary policies. The manual concludes that this contradiction becomes unstable. Unstable is the key word, because Stage 4 creates the conditions for Stage 5. And Stage 5 is where we are right now. Stage 5 is legitimacy collapse. This is when the general population begins to understand that the system is rigged. Monetary policy benefits the wealthy at the expense of everyone else. The purchasing power of their labor is systematically destroyed. The rules are different for different classes. The signs are everywhere. Consider Occupy Wall Street in 2011. The rise of populist politics on both the left and the right is another sign. There is an explosion of distrust in institutions. We also see the emergence of alternative currencies and decentralized finance. A Gallup poll from 2023 shows that only 31% of Americans have confidence in banks. That is only 31%. This represents the lowest level since the Great Depression. Trust in the Federal Reserve has collapsed from 63% in 2007 to 41% in 2024. The legitimacy crisis has arrived. Now, let us examine the pattern. Stage 1. Intellectual infiltration and policy. Normalization. Let us be precise about how this stage appears historically and today. In the Soviet implementation, Stage 1 took approximately 12 years. This period stretched from 1974 to 1986. The mechanism involved placing sympathetic voices in positions of intellectual authority. These were not agents or spies. Rather, they were people who, knowingly or unknowingly, advanced ideas that weakened the target currency's structural integrity. Several specific ideas became normalized. These included central bank independence from democratic oversight. Deficit spending was promoted as economic stimulus. There was also an abandonment of hard currency standards. Keynesian demand management became the primary economic framework. Finally, the idea that inflation below a certain threshold is beneficial gained acceptance. Now, in 2025, we observe the exact same intellectual capture, but in reverse. This is not necessarily by hostile foreign powers. Instead, it is driven by financial interests who benefit from these same policies. The most influential economics departments in the United States, including Harvard, MIT, Stanford, and Chicago, receive significant funding from financial institutions. A study published in the Journal of Economic Perspectives in 2023 found troubling results. It showed that 68% of published papers on monetary policy from 2010 to 2020 came from authors with direct or indirect financial ties to the Federal Reserve System or major banks. That is 68%. The intellectual groundwork has been laid. The ideas are now normalized. Questioning monetary expansion is treated as fringe thinking. Advocating for fiscal restraint is considered political suicide. The framework is now firmly in place. Stage 1 is now complete. Check. Stage 2. Systematic debt expansion. In the Soviet playbook, Stage 2 required the target nation to expand its debt to unsustainable levels. The key was to make each increment seem necessary and justified. Consider a historical example. From 1980 to 1995, United States federal debt grew from $900 billion to $4.9 trillion. The justifications for this growth were varied. These included the Cold War, the Gulf War, and economic recessions. Tax cuts paired with spending increases also contributed. Each reason appeared reasonable in isolation. However, collectively, they created a debt trap. The debt trap works in this way. Once debt reaches a certain level, interest payments become a significant portion of the budget. This crowds out other spending. Alternatively, it requires additional borrowing just to service existing debt. The spiral then becomes self-reinforcing. Here is the modern parallel. United States federal debt in January 2025 stands at $36 trillion. This is $36 trillion. That amounts to 120% of gross domestic product. The debt to gross domestic product ratio has exceeded 100% only twice in American history. These instances are World War II and the present day. However, here's what makes this different. After World War II, the debt was reduced through economic growth and fiscal restraint. The debt to gross domestic product ratio fell from 119% in 1946 to 31% by 1974. This reduction is not happening this time. Congressional Budget Office projections from December 2024 show federal debt reaching 166% of gross domestics product by 2054. This is 166%. This projection is also under optimistic assumptions about economic growth and interest rates. Interest payments on the debt in fiscal year 2024 were $640 billion. This sum is more than the defense budget. It is also more than Medicare. It represents the second largest line item in the federal budget after Social Security. Here is a crucial point. Interest rates are still historically low. If rates rise to their historical average of 5%, interest payments would exceed $1.8 trillion annually. This is $1.8 trillion. That amount is larger than all discretionary spending combined. The debt trap is now complete. The mathematics are inexorable. There is no path to fiscal sustainability without dramatic spending cuts that would trigger a depression. Alternatively, monetary expansion would debase the currency. This is exactly what the KGB manual predicted on page 93. The manual stated that the target nation would reach a point where the debt could not be repaid through taxation or growth. At this point, monetary expansion would become the only politically viable option. This transition would then mark the completion of Stage 2. Stage 2 is well underway. Check. Stage 3. Normalized monetary expansion. For historical implementation, this stage began in earnest in the United States. This occurred with the response to the 2008 financial crisis. The Federal Reserve implemented quantitative easing on a scale never before attempted. $4.5 trillion were created between 2008 and 2014. The mechanism was technical, but also simple. The Federal Reserve purchased government bonds and mortgage-backed securities with newly created money. This action kept interest rates low. It also propped up asset prices and allowed continued deficit spending. The justification provided was crisis response. These were described as emergency measures. They were also presented as temporary interventions. Here is a key insight from the Soviet playbook, found on page 132. The playbook notes that emergency measures become permanent policy. It states that temporary interventions become structural dependencies. It further explains that each expansion makes the next expansion necessary. The system thus becomes addicted to monetary creation. Addicted. That is the precise word. Consider the modern parallel. In March 2020, the COVID pandemic hit. The Federal Reserve responded with the largest monetary expansion in history. $4.6 trillion were created in 18 months. The balance sheet went from $4.2 trillion in February 2020 to $8.9 trillion by April 2022. This was $4.6 trillion in 18 months. That amount is more than was created in the previous century combined. However, here's where it gets disturbing. The expansion did not stop when the emergency ended. In 2023 and 2024, inflation reached 9.1%. This was the highest level in 40 years. Despite this, the Federal Reserve's balance sheet remained above $7 trillion. The emergency measures are now structural. The temporary policies have become permanent. The pattern is accelerating. Let us look at the trajectory. From 1970 to 2000, the Federal Reserve balance sheet grew from $57 billion to $600 billion. This took 30 years. The increase was $600 billion. From 2000 to 2008, the balance sheet grew from $600 billion to $900 billion. This was an 8-year period. It represented a $300 billion increase. From 2008 to 2020, it grew from $900 billion to $7 trillion. This occurred over 12 years. It was a $6.1 trillion increase. The expansion is exponential. Each crisis justifies a larger intervention than the previous one. Furthermore, each intervention becomes the baseline for the next expansion. Federal Reserve Chairman Jerome Powell stated in a press conference on February 14, 2024, that the Federal Reserve's balance sheet would likely remain elevated. This elevation would be compared to pre-2020 levels as they navigate the current economic environment. He used the words elevated and navigate. These are the words of normalization. This acknowledges that what was once emergency policy is now baseline policy. Stage 3 is completing in real time. The addiction is established. The dependency is now structural. Stage 3. We are seeing this right now. Check. Stage 4. Asset inflation and wealth concentration. This historical pattern emerged from 2009 to 2019. The Federal Reserve maintained near zero interest rates. It also expanded its balance sheet. During this time, asset prices exploded. Meanwhile, wage growth stagnated. From 2009 to 2019, the Standard & Poor's 500 increased by 213%. Real estate prices in major metropolitan areas rose by 80 to 150%. Corporate bonds also saw a 93% increase. Average hourly wages only increased by 22% over the same period. The mechanism is straightforward. When the Federal Reserve creates money, it enters the economy through the financial system. Banks receive liquidity. This liquidity then flows to borrowers. Those who borrow at low rates often have collateral. This includes wealthy individuals, corporations, and real estate investors. The newly created money bids up asset prices. This happens before it can diffuse through wages. And consumer prices. By the time the average worker sees any benefit, asset prices have already risen beyond their reach. Consider this example. In 2009, the median home price in San Francisco was $600,000. By 2019, it reached $1.4 million. The median household income in San Francisco, over the same period, rose from $72,000 to $96,000. This demonstrates a clear disparity. The asset appreciated by 133%. Meanwhile, income grew by only 33%. The gap widened significantly. For an entire generation, home ownership became impossible. This is not a mere side effect. It is an inevitable mathematical consequence of monetary expansion. The KGB manual, on page 167, describes this explicitly. It states that asset inflation creates a bifurcated society. Those with assets benefit from monetary expansion. However, those without assets experience purchasing power erosion. They do not have offsetting asset appreciation. This creates conditions for social instability. It simultaneously makes the wealthy dependent on continued expansion. Thus, they become advocates for the very policies that destroy the currency. Now, let us discuss what is happening in the present moment. From 2020 to 2025, we have witnessed the most extreme version of this pattern in history. Consider the stock market. The The Standard & Poor's 500 reached an all-time high of 5,892 on January 3rd, 2025. This represents a gain of 63% since the March 2020 low. This 63% increase occurred in less than 5 years. In real estate, the median United States home price reached $411,000 in December 2024. This was up from $329,000 in January 2020. That marks a 25% increase in just 4 years. Regarding wages, the median wage increased from $48,600 to $51,800 over the same period. This represents a 6.6% increase. The divergence between asset holders and wage earners is accelerating. Asset holders are becoming wealthier at an unprecedented pace. Meanwhile, wage earners are falling further behind. However, here is what nobody tells you. This situation creates a political trap. 43% of Americans now own stocks directly. They also own stocks through retirement accounts. This represents 140 million people. Many of them are middle class. Their retirement security depends on continued asset price appreciation. They become invested, both literally and politically, in policies that maintain elevated asset prices. This means they become invested in continued monetary expansion. This occurs even though the same monetary expansion is eroding their wage purchasing power. The Federal Reserve is now trapped. If they tighten policy aggressively, asset prices will crash. Retirement accounts would then collapse. Political pressure would become overwhelming. If they maintain loose policy, however, inflation will accelerate. Currency debasement would then continue. Either way, the middle class loses. They lose through asset price collapse or through purchasing power erosion. This is the contradiction the Soviet playbook predicted. On page 173, it states that Stage 4 creates an impossible dilemma. The target nation must choose between asset stability and currency stability. They cannot have both. Whichever choice they make, wealth is destroyed. The only question, the manual notes, is whose wealth. Right now, in early 2025, we are watching this situation play out in real time. The Federal Reserve cut interest rates 3 times in the last 4 months of 2024. December data showed inflation still at 3.4%. This was well above their 2% target. However, asset markets were wobbling. A choice was made to support asset prices and accept currency debasement. Stage 4 is here. The signs are everywhere. This stage is now confirmed. Stage 5. Legitimacy, collapse, and alternative systems. This is our current position. We are in the present moment. This is the critical stage. Historically, Stage 5 is characterized by a collapse in public trust in monetary authorities. It also sees the emergence of alternative systems. This occurred in Argentina in 2001. It also happened in Venezuela in 2015. Zimbabwe experienced this in 2007. The pattern is consistent. The public realizes the system is rigged. They lose faith in the official currency. They begin seeking alternatives. These include gold, foreign currency, barter systems, and cryptocurrency. In Argentina, after the 2001 crisis, dollar holdings became more common. This was true for the middle class, more so than peso holdings. People stopped trusting banks. They kept cash at home. They conducted major transactions in dollars, not pesos. In Venezuela, by 2017, the bolivar was essentially worthless. People began using dollars, Colombian pesos, and even crude barter. The government's currency had lost all legitimacy. This is what Stage 5 looks like. The official system continues to function. However, it has lost credibility. People begin routing around it. Now, let me show you what is happening in the United States right now. Cryptocurrency adoption has exploded. In 2020, approximately 27 million Americans owned cryptocurrency. By 2024, that number reached 73 million. 73 million Americans have essentially declared they do not trust the dollar enough to hold all their wealth in it. Bitcoin reached $96,000 in December 2024. Bitcoin is a currency that did not exist 15 years ago. It is backed by nothing except the collective belief that it is better than fiat alternatives. Consider what that means. Tens of millions of Americans are choosing to hold wealth in a digital asset. This asset has no government backing, no physical form, and extreme volatility. They do this because they trust it more than they trust the Federal Reserve. Gold has followed a similar pattern. Gold prices hit $2,700 per ounce in October 2024. This represents a 93% increase from 5 years earlier. People are fleeing to hard assets. However, here is where it gets more significant. The legitimacy crisis is not just among retail investors. It is also institutional. In 2023, central banks purchased 1,037 metric tons of gold. This was the highest level since 1950. These are central banks, the very institutions that issue currency. They are buying gold. They are hedging against their own currencies. China has increased its gold reserves by 37% since 2020. Russia has increased its reserves by 41%. Even Western central banks are accumulating gold. This is not a conspiracy theory. This is published data from the World Gold Council. The custodians of the global monetary system are preparing for the system's potential failure. Let me provide another data point. Cross-border payments using blockchain technology grew by 234%. This occurred from 2022 to 2024. Companies and individuals are increasingly bypassing traditional banking systems. They are using decentralized networks instead. Stablecoins, which are cryptocurrencies pegged to the dollar, now have a market capitalization of $193 billion. People want dollar exposure without holding dollars in traditional banks. The legitimacy collapse is here. It is measurable. It is accelerating. Survey data confirms this trend. According to Pew Research, in December 2024, 58% of Americans believe the economic system is rigged to benefit the wealthy. Only 29% trust the Federal Reserve to do what is right for the economy. 43% of millennials believe cryptocurrency is a better long-term store of value than the dollar. These are not fringe views. This represents majority or near majority opinion. The Soviet manual describes this stage on page 207. It states that stage 5 is characterized by a bifurcation between official narratives and lived experience. Authorities insist the currency is stable. Meanwhile, the population experiences erosion. Trust collapses. Alternative systems emerge. The authorities face a choice. They must either accept the alternatives or suppress them. The manual notes that either choice accelerates the crisis. And here is where we are right now in January 2025. That crucial choice is being made. The Securities and Exchange Commission has approved Bitcoin exchange-traded funds. This legitimizes cryptocurrency. Simultaneously, the Federal Reserve and Treasury have begun exploring central bank digital currencies. These would allow unprecedented control over currency transactions. On one hand, there is acceptance of alternatives. On the other hand, there is preparation for control. The system is currently at an inflection point. This is stage 5. This is our current position. This is the moment before the final collapse. Stage 6 refers to hyperinflation or a currency reset. This is the terminal stage. It represents the point of no return. Let me be absolutely clear. We are not in stage 6 yet. We are at the threshold. However, stage 6 is a mathematical inevitability if current policies continue. Historical examples of stage 6 are brutal. Consider Weimar Germany in 1923. The German mark plummeted from 4 marks to the United States dollar in 1919. By November 1923, it reached 4.2 trillion marks to the United States dollar. This represented an astonishing 4.2 trillion. People were paid multiple times per day because prices changed by the hour. A cup of coffee in the morning cost thousands of marks. By evening, the same cup cost millions of marks. Life savings were annihilated. The middle class was destroyed in less than 2 years. Zimbabwe offers another example in 2008. The official inflation rate reached 79 billion%. This was an astronomical 79 billion%. The government eventually abandoned its currency entirely. People resorted to using United States dollars, South African rand, and other foreign currencies. Venezuela faced a similar crisis in 2018. Inflation hit 1 million%. The government eventually removed 6 zeros from the currency. Consequently, 1 million old bolivars became 1 new bolivar. Wealth was mathematically eliminated. This is what Stage 6 looks like. It follows a predictable pattern. First, inflation accelerates beyond the central bank's control. The initial response is to tighten policy. Authorities raise interest rates. They also reduce the money supply. However, this causes asset prices to crash. It also triggers a recession. Political pressure then forces a reversal. Second, the central bank returns to expansionary policies. However, the public now understands this playbook. They expect more money printing. Consequently, they begin front-running it. They dump currency faster. Inflation then accelerates beyond the rate of monetary expansion. Third, a feedback loop develops. More money printing causes more inflation. More inflation causes less confidence. Less confidence causes more dumping of currency. More dumping causes even more inflation. The spiral becomes self-reinforcing. Fourth, the government attempts price controls. These include rationing and criminalizing alternative currencies. They may also implement emergency powers. However, these measures always fail. Black markets emerge. Official statistics become meaningless. Fifth, the currency either hyperinflates to worthlessness, or the government implements a currency reset. A new currency is introduced. It typically has several zeros removed. Debts are restructured or defaulted upon. Wealth is redistributed. This usually happens away from the middle class. The final section of the KGB manual, pages 238 through 263, describes this endgame. It states that Stage 6 is inevitable once Stage 5 reaches a critical mass. The only remaining questions are timing and severity. A slow-motion collapse can take 5 to 10 years. A rapid collapse can take 18 to 36 months. The manual notes that the outcome is identical. It involves purchasing power destruction, wealth transfer, and social upheaval. Let me show you the warning signs that indicate Stage 6 is approaching. First, consider fiscal dominance. This occurs when government debt levels force the central bank to prioritize debt servicing. They do this over maintaining price stability. The central bank can no longer fight inflation without triggering a government debt crisis. The United States is approaching this threshold. The national debt stands at $36 trillion. Interest payments amount to $640 billion annually. Even a modest rate increase would add hundreds of billions to these interest costs. The Congressional Budget Office estimates a 2 percentage point rate increase. This would add $400 billion to annual interest costs within 3 years. The Federal Reserve is losing its independence. This is not happening legally, but practically. They cannot tighten monetary policy without risking a fiscal crisis. Second, Observe the declining demand for government bonds. When buyers lose confidence, governments face a choice. They must either pay higher rates or their central bank must buy the bonds. The central bank buys these bonds with printed money. Both actions lead to currency debasement. Foreign holdings of United States Treasury bonds have declined. They went from 34% of total outstanding in 2015 to 29% in 2024. China has reduced its holdings from $1.3 trillion in 2013. Now, these holdings stand at $779 billion in 2024. Demand for these bonds is declining. The implications are obvious. Third, observe the acceleration in the velocity of money. This is the rate at which money changes hands. In normal times, money velocity is stable. However, in currency crises, velocity accelerates. People spend money quickly before it loses value. The M2 velocity of money had been declining since 2000. However, it began rising sharply in late 2023. This serves as an early warning indicator. When people start spending currency faster, inflation can spiral beyond control. Fourth, real interest rates are turning deeply negative. Real interest rates are nominal rates minus inflation. When they are significantly negative, holding currency becomes a guaranteed losing proposition. In December 2024, the 10-year Treasury yield was 4.2%. Inflation stood at 3.4%. This resulted in a real yield of 0.8%. That is barely positive. If inflation ticks up even slightly, real rates turn negative. At that point, holding government bonds guarantees purchasing power loss. These are the warning signs. All of them are now flashing. Here is the key point about Stage 6. It does not require malicious intent. It does not require a conspiracy. It is the mathematical outcome of Stages 1 through 5. Once the mechanisms are in motion, Stage 6 becomes inevitable. This happens when the debt is too large. It occurs when money printing has gone too far. It also materializes when legitimacy has collapsed. The only question is whether this collapse happens slowly or quickly. A slow motion Stage 6 looks like chronic high inflation. This means 5 to 10% annually for years. Purchasing power erodes gradually. The middle class slowly becomes poorer. Asset prices remain elevated. However, they do not keep pace with cost of living increases. This represents the best case scenario. A rapid Stage 6 looks like the historical examples. It involves hyperinflation, currency collapse, and wealth annihilation. It also causes social upheaval. This represents the worst case scenario. Right now, as of January 2025, we are not in Stage 6. However, we are at Stage 5. We are approaching its threshold. The mechanisms that lead to Stage 6 are active. The warning signs are visible. How much time do we have? It is impossible to know precisely. However, the historical pattern suggests 18 months to 5 years. This period begins from the point where Stage 5 becomes obvious. Stage 5 became clear in 2023. Inflation hit 9%. Trust metrics also collapsed. That puts the potential Stage 6 window at late 2024 to 2028. The pieces are moving into place. Now, let us talk about what is happening right now. This is an evidence compilation. On February 6th, 2024, Federal Reserve Chairman Jerome Powell testified before Congress. He stated that the Federal Reserve was committed to bringing inflation back to its 2% target. However, in the same testimony, he acknowledged a key limitation. The Federal Reserve cannot raise rates significantly without risking financial stability. This translates to a trapped position for them. They cannot fight inflation without crashing asset prices. On March 15th, 2024, the Congressional Budget Office released its long-term budget outlook. It projects deficits averaging $2 trillion annually for the next decade. This amounts to $2 trillion every single year. This requires continuous bond issuance and monetary accommodation. On May 2nd, 2024, China and Saudi Arabia conducted their first oil transaction. It was settled in yuan instead of United States dollars. This represents a direct challenge to dollar hegemony. For 50 years, global oil trade has been denominated in United States dollars. That monopoly is now ending. On June 18, 2024, the BRICS nations announced plans. These nations include Brazil, Russia, India, China, and South Africa. They plan an alternative payment system to bypass the dollar-based SWIFT network. 36% of global gross domestic product is now coordinating. Their goal is to reduce dollar dependence. On July 9, 2024, United States consumer debt reached $17.3 trillion. This includes student loans, auto loans, credit cards, and mortgages. American households are leveraged to unprecedented levels. When inflation erodes purchasing power, defaults accelerate. On August 23, 2024, the yield curve had been inverted for 18 consecutive months. The yield curve represents the difference between short-term and long-term interest rates. Every recession in the past 70 years has been preceded by an inverted yield curve. The countdown has started. On September 11, 2024, real wages had declined for 36 consecutive months. These wages are adjusted for inflation. People are becoming poorer in real terms. Their paychecks buy less each month. This represents stage 4 in action. On October 5th, 2024, gold reached $2,700 per ounce. Bitcoin reached $73,000. The flight to hard assets is accelerating. People are seeking alternatives to the dollar. On November 14th, 2024, Federal Reserve meeting minutes were released. They revealed internal debate about whether inflation is truly transitory or structural. This uncertainty is telling. They do not know the answer. The system is beyond their control. On December 1st, 2024, United States national debt crossed $36 trillion. It took the entire history of the country until 1981 to reach $1 trillion. Conversely, it took only 3 years to go from $33 trillion to $36 trillion. The acceleration is exponential. On January 9th, 2025, a survey of institutional investors was released. It showed 67% expect significant dollar devaluation within 5 years. The smart money is clearly positioning for collapse. On January 14th, 2025, the Federal Reserve cut rates by 25 basis points. This occurred despite inflation remaining above 3%. They chose asset stability over currency stability. The trap has now closed. Each of these data points connects to the historical pattern. Each one echoes what happened in previous currency collapses. Each one represents another step towards stage 6. Recall stage 2 from Weimar Germany, which involved debt expansion. The current deficit trajectory follows this exact same mechanism. Recall stage 3 from Argentina, involving normalized monetary expansion. The Federal Reserve's balance sheet remaining elevated follows this exact same mechanism. Recall stage 4 from Zimbabwe, which saw asset inflation while wages stagnated. The current wealth divergence follows this exact same mechanism. Recall stage 5 from Venezuela, involving legitimacy collapse and flight to alternatives. The cryptocurrency boom follows this exact same mechanism. The pattern is not theoretical. It is not a historical curiosity. It is happening right now. We observe the same sequence, the same mechanisms, and the same trajectory. Now, let me show you who wins and who loses when this pattern completes. The winners are obvious. These are the people who own hard assets. They have debt that will be inflated away. They are positioned in inflation-resistant investments. The wealthy who hold stocks, real estate, commodities, and foreign currencies also win. They benefit from asset appreciation and debt erosion. Large corporations with pricing power also win. They pass costs to consumers while their assets appreciate. Financial institutions that originate debt also benefit. The debt gets repaid in devalued currency. These institutions profit from the spread. Government entities with fixed debt obligations also benefit. Their $36 trillion in debt becomes easier to service as the currency debases. The global wealthy elite are geographically and asset class diversified. They move wealth across borders and currencies. They are insulated from any single currency collapse. But here are the losers. The middle class loses. This includes people with savings in dollars. It also includes those on fixed incomes. Those who live paycheck to paycheck lose the most. You are among them. Your savings account earns 1% interest. Inflation runs at 3 to 5%. You are losing 2 to 4% of purchasing power every year. This loss compounds annually. Consider your retirement account. If it is in bonds or cash-heavy portfolios, those assets get destroyed by inflation. A retirement account worth $1 million today will buy what $500,000 buys now. This assumes 50% cumulative inflation over the next decade. 50% is a conservative estimate given the historical pattern. Your paycheck also loses value. Even with a 3% raise each year, you are getting poorer if inflation runs at 5%. Your labor is worth less in real terms each year. Your children's future is also at risk. They inherit an economy with massive debt and devalued currency. They also face diminished opportunity. The American dream becomes mathematically impossible when currency debasement outpaces wage growth. Your purchasing power for essentials diminishes. Food, energy, housing, and healthcare are hit hardest by inflation. From 2020 to 2024, grocery prices increased by 28%. Housing costs increased by 32%. Healthcare increased by 19%. Consider these facts. In 4 years, essential living costs increased by 1/4 to 1/3. Your wages did not keep pace. Wages rarely keep pace with inflation. They never have, and they never will in this system. This is not hyperbole. This is the mathematical outcome of monetary expansion and currency debasement. This is what happened to the German middle class in the 1920s. It happened to the Argentine middle class in the 2000s. It also happened to the Venezuelan middle class in the 2010s. Page 223 of the KGB manual describes this wealth transfer explicitly. It states that currency warfare appears natural. It appears to be driven by market forces or economic inevitability. The population does not realize they are under attack until the transfer is complete. By then, they are impoverished. The wealthy have captured the real assets. This is legal theft. It is systematic and structural. It is inevitable under current policies. You can be morally outraged. You should be. However, moral outrage without action is just emotional self-harm. The system is rigged. This is true. The policies are destructive. This is also true. The wealth transfer is intentional. Yes, it is. And it is happening whether you acknowledge it or not. Here's what you need to do. You need to do it now, not later. The choice you face is simple. Adapt or get destroyed. Position yourself among the winners or resign yourself to the losers. First, understand your enemy. Your enemy is not Russia, China, or some foreign power. Your enemy is monetary debasement. It is every dollar in your savings account losing value every single day. Your enemies are time and inflation. Second, accept reality. The system will not fix itself. There will be no political savior. The debt cannot be paid. The deficit cannot be eliminated without triggering a depression. Monetary expansion will continue because it must continue. This is the trap. You must accept it. Third, you must act. Do not wait for next month. Do not wait to do more research. Act now. Here is your plan. Week 1 involves the assessment phase. Take inventory of your entire financial position. List every account, every asset, and every liability. Write down all details. Calculate what percentage is in dollar-denominated cash or cash equivalents. That is your exposure. This is what is being destroyed. If more than 20% of your net worth is in cash, savings accounts, or money market funds, your exposure is dangerous. You are holding the melting ice cube. Calculate your debt. If you have fixed rate debt, like mortgages and student loans, this is beneficial in an inflationary environment. You are repaying these in devalued dollars. If you have variable rate debt, such as credit cards or adjustable mortgages, that is dangerous. Those rates will rise as inflation accelerates. Week 2 focuses on immediate protection. Open accounts with at least 2 different brokerages. Diversification is not just about assets. It is about counterparty risk. If one institution fails or freezes withdrawals during a crisis, you will have alternatives. Move excess cash out of checking accounts. Keep only what you need for 3 months of expenses. Everything else needs to be invested. Begin dollar cost averaging into hard assets. Consider gold, silver, and Bitcoin. Start small if necessary. $100 per week is better than nothing. The point is to establish the position and the habit. Week 3 involves an asset allocation shift. If you have significant savings in dollar-denominated accounts, begin shifting to inflation-resistant assets. This does not mean selling everything in a panic. It means systematic reallocation. Target allocation for middle-class protective positioning is as follows. Allocate 10 to 15% to precious metals. Gold is primary, and silver is secondary. Choose physical metals if possible, or exchange traded funds if necessary. Allocate 10 to 15% to cryptocurrency, with Bitcoin being primary. This acts as insurance against currency failure. Assign 20 to 30% to equities with pricing power. These are companies that can pass costs to consumers. Avoid bonds entirely. Bonds are the worst asset class in an inflationary environment. Week 4 focuses on your debt strategy. If you have high-interest variable debt, prioritize paying it down. That is your highest return in an uncertain environment. If you have low-interest fixed debt, do not pay it down early. Inflation is doing that for you. Instead, redirect those dollars to hard assets. If you are considering major purchases, understand that waiting means paying more later. If you need a car, a house, or major appliances, the price will be higher in 6 months. The financial calculus has changed. Saving up to pay cash is no longer optimal when currency is debasing. Month 2 is about income diversification. Your wages are being destroyed by inflation. Sitting still is not an option. You need to increase income and change jobs. Develop side income. Acquire skills that demand higher wages. Job switching is the fastest way to increase wages. People who change jobs see wage increases of 10 to 15%. People who stay see increases of 3 to 4%. Do the math. Seek side income in inflation-resistant areas. If you have skills in trades or physical services, develop those income streams. This applies to anything that cannot be easily automated or offshored. Month 3 is dedicated to knowledge building. This is not a short-term crisis. It is a long-term structural shift. You need to understand what is happening at a deep level. Read economic history. Read about Weimar Germany. Read about Argentina. Read about Venezuela. Understand the pattern. The pattern repeats because human nature and government incentives are consistent. Follow monetary policy in real time. Monitor Federal Reserve meetings and Treasury announcements. Review Congressional Budget Office reports. This information is your intelligence. It tells you where we are in the sequence. Connect with people who understand this. Find online communities and local groups. The mainstream will call you paranoid or extreme. Ignore them. They will be blindsided when stage 6 hits. Now, let me address a common objection. You may think this sounds extreme. You may think this is doom-mongering. Perhaps you believe the system has survived before and will survive again. Let me show you why that is wrong. Yes, the system has faced crises before. These include the Great Depression. They also include the 1970s stagflation. The 2008 financial crisis is another example. The system survived these events. However, each time the solution involved monetary expansion. Each time the debt grew larger. The mechanisms of Stage 5 intensified with every crisis. We are not facing a crisis like previous ones. We are facing the culmination of a 70-year debt accumulation. It is also the result of a 20-year monetary expansion binge. The debt to gross domestic product ratio after World War II was 119%. It was reduced to 31% over 3 decades. This reduction came through growth and fiscal restraint. We are at 120% now. The current trajectory is upward, not downward. There is no political will for restraint. There is no economic path to growth that outpaces debt accumulation. This time is different. Not because human nature has changed. Not because economics has changed. The mathematical constraints have been reached. You cannot grow your way out when debt service exceeds revenue growth. You cannot save your way out when cutting spending triggers a depression. The only remaining path is currency debasement. The choice is not between doom and normalcy. The choice is between controlled devaluation and uncontrolled collapse. If you understand that choice, you understand why protective positioning is not paranoia. It is mathematics. Here's another objection. You may think you do not have enough money to make this worthwhile. Perhaps you're living paycheck to paycheck. How can you buy gold or Bitcoin when you can barely cover rent? Let me be direct. If you are living paycheck to paycheck, you are the most vulnerable person in this entire scenario. You have no buffer. You have no assets to appreciate. You have only your labor. Your labor is being systematically devalued. The answer is not to give up. The answer is to start small and be consistent. Invest $10 per week into Bitcoin. 52 weeks totals $520. That amount is not nothing. That is a position, and that is protection. Buy 1 ounce of silver per month for $30. Over 12 months, this is $360 and 12 ounces of silver. That is real money when currency collapses. The point is not to get rich. The point is to not get destroyed. There is a massive difference between those two goals. Here is the final objection. You might think this is immoral. Positioning yourself to benefit from a collapsing system may seem like profiting from others' pain. Let me show you the moral dimension. Some of you are thinking this is not fair. You are right. It is not fair. It is theft. It is legal theft. However, it is happening whether it is fair or not. You can be morally outraged and financially destroyed. Alternatively, you can be morally aware and financially positioned. I would rather you survive and fight another day. Do not lose everything standing on principle. The people running this system are already positioned. This includes central bankers, politicians, and the financial elite. They own hard assets and have diversified portfolios. They are protected. Your moral stand does not hurt them. It only hurts you and your family. Position yourself to survive. Then, with resources intact, you can work to change the system. Broke and bitter people do not change anything. Financially stable and informed people have the resources and credibility to advocate for reform. The choice is simple: adapt or get destroyed. Stage 5 is complete. The legitimacy collapse has happened. Trust is gone. Alternatives are emerging. The mechanisms of Stage 6 are beginning to activate. Over the next 18 to 36 months, we will see whether this is a slow-motion devaluation or a rapid collapse. The pattern suggests we are closer to the rapid scenario than most people realize. The Federal Reserve is trapped. They cannot raise rates without crashing asset prices and triggering a recession. They cannot keep rates low without accelerating inflation and currency debasement. The federal government is trapped. They cannot cut spending without triggering an immediate economic contraction. They cannot keep spending without accelerating the debt spiral. The American people are trapped. They cannot save their way to prosperity when their currency is debasing. They cannot work their way to wealth when wages do not keep pace with asset inflation. Something has to break. The mathematics demand it. The KGB manual's final page, page 263, states that the final stage is not destruction for its own sake. Instead, it is creative destruction. The old system must fail for a new system to emerge. The manual clarifies that the question is not whether the transition happens. Rather, it is about who controls the new system and who has positioned themselves to thrive in it. The critical question is who controls the new system and who has positioned themselves to thrive. That is the question you need to answer right now, today, because the pattern is clear. The stages are sequential. The mechanisms are in motion. And we are at Stage 5, approaching Stage 6. The 70-year debt accumulation, the 20-year monetary expansion, the 4-year legitimacy collapse. It is all leading to the same destination that the KGB manual predicted in 1974. This outcome includes currency reset, wealth transfer, and social upheaval. Ultimately, it means the destruction of the dollar as we know it. You can wait and hope this is wrong. You can watch and see what happens. You can trust that the authorities will fix it. Or you can recognize the pattern, accept the reality, and take action to protect yourself and your family. The choice is yours. But the choice has a deadline. And that deadline is measured in months, not years. The 6-stage pattern has played out 17 times in modern history. 17 times, millions of people saw their wealth destroyed because they did not recognize the pattern until it was too late. Do not be the 18th.